I'm a kid from Ann Arbor. I got into a fancy business school, Harvard, wanted to be rich, got into private equity, realized really quickly that it's better to own the equity than work for other people to own the equity. So I spun out and I was an independent sponsor, which I just call like a former private equity or investment banking dude that's doing it deal by deal. And then I did that for a while, and then my business partner effectively retired, and so I spun out and I was a self-funded searcher before it was even called that. I was pretty early. Worked on a couple deals, one that kind of took the last of my budget, didn't work out, threw me into a tailspin, so I took a year off, a gap year, and I'm like, I have all these investing skills, what the heck am I gonna do with them? And it was right around the time, 2018, when like Roland Frazier, Cody Sanchez were getting really crazy with, oh, no money down deals, easy, no diligence, just, you'll be fine. And so I said, I don't want regular people that are putting up personal guarantees to go to the poorhouse. So I started Guardian Due Diligence to be an avenue for folks that were smart enough to know to not do this alone, to have a solution that was not just financial diligence oriented. Because like when you're like a financial dude, you can just have an accounting tool kind of help you with the diligence. But when you're a self-funded searcher and not a super finance dude or dudette, you need more of a comprehensive solution. So Guardian was meant to be that, and now we have a Masterclass as well that we launched last year. And I really enjoy these topics because I was an undergrad engineer and then I get to business school and I'm like, hold on, all this complicated finance stuff is just addition, subtraction, multiplication, and division? That's it? Oh man, come on, let's go. And so ever since then, I've been trying to kick the butt of all the Wall Street finance bros and then also making it kind of reasonable for everybody who probably doesn't want to go to Wall Street and work there. So I was fortunate enough, two of my clients are willing for me to share their stuff. It's a couple years old, so not a big deal. One is a deal that got consummated and we can go through the SIM, the income statement and the balance sheet. Because I think where the real fun is sort of in between the craft the broker sends and what's really there and what you really need to know. And then the second one is one that didn't really have a SIM. You know, it's like those 2 pages in the tax returns that you get sometimes. And so I'm gonna take you from when someone tells you what kind of revenue and profit they're making, but nothing on the balance sheet, how does the balance sheet affect EBITDA, cash flow, et cetera? And my goal is to put nobody to sleep. So this is a stone business. It was presented by Transworld. Bianca's actually a pretty cool broker. High level details, it's about a $3.5 million purchase price. You'll see this kind of stuff in Sims quite a bit. You'll see this stuff a lot, annual sales trends. So that's great, but you can't spend revenue, right? So you'll see financial analysis like this. So P&Ls, since we're having fun interactively, who's good enough to describe these first 4 areas on an income statement in abstract form? That was actually the right answer. That's a bunch of stuff going on in here. So I wouldn't trust any of these. Net profit is typically net income directionally, but net income on financial statements is different than taxes. In the United States, you are free to present your taxes in any way you want to, subject to recourse from the IRS for lying. Most people do it on a cash basis, but they're typically not one-for-one to the financials. The financials, net profit is typically net income, which is revenue minus all the income statement expenses, and we'll get into a more detailed list of that in a second. So then people will show the P&Ls and the books that they send. They love these pre-qualification letters that have stuff in them. And so that's a typical SIM. So let me go into the quality of earnings that we did for this so we can hop into the income statement and the balance sheet. And then what I want to do is leave this PDF on this sheet to be able to come back to it. So they said in 2021, the total order benefit was 1.2. All right. Just as a comparison, so revenue, we were close. They have 5.8, we had 5.7. Net income, 949, they had 998, so not bad. They had 1.2 in owner benefit. and we actually had a bit higher for 2021. So let's go through what's in this stuff so you guys can understand it better. I'm going to start with the add backs at a summary level and then hop into the detailed income statement. So most of our QOEs are going to start at net income, and then we're going to build in management adjustments. That's what the management tells us. We're going to build in due diligence adjustments. That's what our analysis shows us. And then we're going to put in due diligence adjustments, some of them being non-quantifiable. But if we go into the income statement, this is a more detailed look at that same year, 2021, that was in the PDF. Now, when we talk about cost of goods sold, let's double click on that. So what is the kind of official definition of cost of goods sold? What should be in here? What should be out of here? Anybody want to take a shot? So it is all of the sort of direct and indirect expenses associated with delivering a good or service. So if I go to a detailed income statement, if I look at revenue and the discount here, and then I look at cost of goods sold is going to include things like expense reimbursement, shop supplies, equipment costs, production commissions, material and freight costs, subcontractor costs, so labor. One of the things that most small businesses don't do, most of them loop everything into sort of operating expenses because it's a little bit harder to put it into cost of goods sold and then operating expenses separately. But what you need to do if you truly want to look at gross profit and truly want to look at the staff in your business that's actually contributing to the good or service versus the staff that's doing something else. You want to put the portion of the labor that's related specifically to the good or service in cost of goods sold. And then, just because we're having fun, how often do you think I can look at cost of goods sold on an SMB deal's income statement and think it's 90% correct? You think it's a coin toss? Do you think it's 25%? How lucky? That's an excellent answer. So here's where like the nerd in me is gonna go, and then I'm gonna pop back out to a normal dude. So first off, to get the labor component, you have to ask a seller how well do they track labor on an overall or a per job, per product basis. For instance, if it's a manufacturing facility, the shop manager, is that person in cost of goods sold or operating expenses? If you do 100 jobs a year, do you separate the person that delivers the goods half his time but works a machine the other half? Do you separate that specifically? All those kind of things have to be asked. Also, a lot of owners don't track their material costs very well. So this was a granite stone business for people who like, fancy countertops in their kitchens and bathrooms. So maybe you track the stones really well as a cost of goods sold, but what about the faucets and fixtures and all that kind of stuff? So the first thing you have to do as a sort of income statement analyzer is sort of understand, all right, cost of goods sold are all the products and labor associated specifically with the good or service. And then let me ask, how good do you track those things? Because I want to ask that first, because if I ask you, are all the costs associated with the products and the services that you deliver in your cost of goods sold? Oh, heck yeah, Elliot, absolutely. So before you get there, you want to ask, how well do you track it? Because you wouldn't expect someone that didn't track it well to have it accurately. And then you might need to take a swag at it if you wanted to correctly state the gross profit. You also might come to a place where the best swag you have is, well, I think half my labor is related to the products or services and half is administrative. And you may have to roll with that in some situations on smaller deals. Does that make sense? In this case, I don't remember because this deal's a bit old, what's in cost to get sold other, and I don't want to make something up just to answer the question. But you'll often find two reasons why you'll see something like that. You'll see it if it might be what you just described. Sometimes we'll use it as a catch-all for other stuff that as we learned about the business and how they actually function, we realized that some of the stuff that was in operating expenses should have been in cost of goods sold, and we wanted to move it up into cost of goods sold. So another important question to ask if I was sitting in front of the CPA of this A1 Stone is, what's in cost of goods sold other? You'll also see a lot of ask my accountants, and you need to ask what's in there. And frankly, you need to allow the seller to say, oh, that's where all my gambling money and my beer money is, right? Because people put wonky stuff in there, and if you don't kind of allow people to tell you the truth, you might get a wonky answer. So cost of goods sold is also important because when you guys are thinking about buying your businesses, you are more likely to be able to take cost out of operating expenses than cost of goods sold. The cost of goods sold, typically the seller's not overpaying people, not overpaying for products. And so when you think about the portion of revenue that goes to cost of goods sold, and the cost of goods sold is stated correctly, you can believe that there's probably 5 or 10% you can make it more lean, but it's unlikely you're gonna move it substantially. And then the other thing about cost of goods sold and gross profit, more gross profit. Are you guys familiar with IBIS World, IBIS World? Anyone? So if you go on Search Funder or if you pay for a subscription, there's industry reports called IBIS World. And it's no different than Goldman Sachs industry report on kitchen remodeling, right? But one of the metrics that those IBIS World reports will give you is gross margin per industry. And so if you were to get to an IBIS report that said, okay, well, these are for kitchen remodelers or home remodelers, and the average gross margin or gross profit is on 400,000 in October of 248. So we're talking about, okay, it's 60%. You'd be able to track that and say, okay, is this person a lot higher in gross profit or lower? And that's why getting the cost of goods sold can also be helpful, because in industries you don't know, you can get a sense of whether this business is doing well from purchasing their products and paying their labor perspective. Does that make sense? So now I'm gonna hop into the expenses. So some of these are pretty obvious, but the reason I think financial statement stuff is fun is because how often sellers will try to play some games with this stuff. So the way I'm gonna go through the rest of these expenses, I'm gonna ask you guys, what kind of games do you think somebody could play with this? Now, some of these games will end up showing themselves in the add backs, right? But if you go to the detailed income statement, that's where the games begin, and that's why you wanna spend time there, because it's more easy to pull things out. So they don't have much in bank service charges or reconciliation discrepancies, but marketing expenses. So in these kind of expenses, how do you think sellers play games? That's good. So most sellers or owners probably have the same experience, Peter, because I do. I've overpaid for marketing. I've had to actually revamp my whole marketing team this year, kind of 1.5 times. If I was selling my business, I'd want to tell you, oh, those old folks, they were too expensive. This new leaned out team is more representative of the marketing that you need going forward. And I may have just gutted 50% of my team. And maybe I don't show that until the 2 or 3 months before the deal consummates, but that's one game people will play. I've seen a lot of games played with website expenses. So in this case, their website was really expensive. So like I would be asking, I think these are, are these in dollars? These are in dollars. Sorry, it's really cheap. Did you really pay $100, $250 for your website? Now on a stone business, that might be the case, but if you were dealing with the professional service business that had back ends and testimonies and all the rest of that stuff, you'd be asking, yeah, I think you spent a bit more on that than what you're saying. If you see advertising, particularly Now, most of the advertising you're going to see is going to be digital. People don't do billboards as much anymore. Uh, One of the things you'll get a lot here is, oh, that old squad that we had, they were terrible at return on ad spend. But look, our new squad is getting a four times return on ad spend. Do you guys know what return on ad spend is? If you have someone doing Google ads, someone doing YouTube ads, someone doing TikTok ads, someone doing Instagram ads, and they're different, they will all give you return on ad spends, and a seller may tell you the highest one. Oh, our Google ads are 4x return on ad spend, blah, blah, blah. Well, the nice thing is on the income statement, you can actually look at it, and on an absolute basis, you can look at the whole year versus advertising relative to the whole year versus revenue and actually see what it is. But I'll tell you that I haven't heard an accurate return on ad spend in a confidential information memorandum yet in the 5 or 6 years I've been running Guardian. So never trust it, validate it, and you're right, it's revenue and not profit. So you could be running positive multiple return on ad spend with a business that's still not making any profit because you could spend it all on operating expenses or some other thing. Here they have lead referral commissions. So like in January 21, they had $4,200 of lead referral commissions. You would absolutely want to double click on what is that, who'd you pay it to? Is it the best friend of the seller who you're taking out of the business? Is it a market-based transaction? Like, can you call that same person for a referral? Or is it something that's going to go away when you buy the business? But when I think about marketing expenses, my head goes to where do people play games? And those are some ways that people play games. I hope that was helpful. Harder doing business. And in fact, do you think you'll be able to do marketing better than the seller and their team that's been at it for 5 years? And there's certain mistakes they didn't make in 2024, for instance, that you probably gonna make in 2025 or 2026. I promise you, right? TikTok, I'm gonna launch the TikTok marketing strategy. You're gonna lose on that. You're gonna, like Peter said, you're gonna pay agencies that aren't gonna deliver. People are gonna run BS spend through, I know Google well enough to know if you put a budget of $100, they're damn sure gonna spend your $100. Whether it's on the people you allocated in your Google ads or not is questionable, but the $100 is gone. Steve, I saw you went off mute. So I'm gonna go there. This is, I'm gonna put under the label of BS stuff that owners do that you should absolutely validate and put more seller note behind because it's very hard to track. Bartering and cash payments. So then let me give you a range of like one that I saw where we had to do something wild. I'll do that second. And one that I see that's not a big deal. If there's a company and you do embroidered shirts and you run up a $10,000 bill with the advertising company and you say, hey, I'm gonna give you $10,000 worth of shirts for the $10,000 worth of advertising. There was an invoice, there were services, you can track it. Whether you gave cash or the equivalent in goods is kind of irrelevant. In fact, the goods are better off from a profit perspective because you have profit in it, right? That's one thing, not a big deal. If it's like 0.5% of like revenue or profit, you also don't care much at all. But I had some friends in Dallas that were buying a construction company, and it was two like former private equity dudes, and I love working with these guys because they love their spreadsheets, but like they ain't seen a construction site in a long time. And so we were talking about, oh yeah, he's making a lot of money. We see his boat, we see his house. You know, it's a lot of cash, but he's not showing much on the income statement, Elliot. So, you know, help us out because we don't want to lose our shirt. And so we start talking to the guy, and he barters for everything, and nothing is tracked. And he takes cash payments. So it's like he was doing a lot of tiny houses. So he'd do 3 or 4 tiny houses for somebody's hunting thing in Texas, and somebody would show up in the office with a bag full of money. He had it on some spreadsheet somewhere, how much money was in the bag full of money. And then the next one he does, he'll do 3 tiny houses for somebody else, and he'll barter for that person to do his personal, you know, pool in his backyard. And then you start going like this, And the fourth or fifth story I heard, I did the math on the quality of earnings, and I had to come back and say, hey, look, clients, I'm not going to be able to prove this stuff out. That doesn't mean that it didn't happen. It just means that from a quantitative, valid, audit-like quality of earnings, I'm not going to be able to validate this stuff. So I don't want to finish the second half of our work, because I kind of let people quit at the halfway point. I don't want to finish the second half of our work and you not know that, because I know that now. So they took a week to kind of think about it, whether they were going to do the second half, and then they actually got smart. So this time the private equity actually helped. So they were able to negotiate with the seller that, look, my private equity guy or my QOE guy and my banks aren't going to accept all these add backs. We believe it. We'll pay you X at closing, primarily based on real estate and maybe a little bit of a down payment. The rest is going to go in a seller note. We do think that the seller note is going to pay out because that stuff's going to happen again. But if it doesn't, we won't. And so they did the deal without finishing the QOE, largely on a seller note. So when I started this whole thing, I said, this is like the category of stuff you have to kind of solve with a big A seller's note. That's typically how you solve it, unless it's like such a small thing and so trackable that it's not material to the business. No, we don't assume anything. We don't assume or believe anything. So I think items that are more than 10 or 15% of EBITDA, so if you put a multiple on it, it'd be more than 10 or 15% of purchase price, are material enough for someone to renegotiate or potentially kill a deal. And so my first question is this stuff bigger than 10% of EBITDA? Right, kind of yes, no. If it's less, maybe I would negotiate a slightly bigger seller note, maybe I negotiate a larger transition period, maybe I say, hey man, throw in an extra 100K of working capital and I'll believe your thing and off we go. If it's bigger than 10%, then you really need to adjust for it. And that's where cash payments and bartering are different. There's no freaking way you're gonna unravel somebody's bartering. So like, I met Athena in April at the Essen Bash. If we start bartering Aquamats for Guardian, there's no way you're gonna get the both of us in a room, we're gonna snitch on each other. If she's selling and we're friends, I'm gonna be quiet on the tough questions around whatever that is, right? And anybody who's done bartering in house stuff or anything, those are your buddies, only people you trust can you do that with. So for those, you almost have to say, hey, I wanna believe you, but I gotta see that stuff pan out again, so the next time I wanna barter, I can barter, because bartering is higher profit than paying out dollars. So if I get the same amount of bartering benefit in the first 6 months or year as you did in the past 6 months or year, then that part of the seller note will pay out. If not, then either I shouldn't have believed you or it didn't repeat. Either way, I shouldn't pay that out. So on bartering, you sort of have to make the assumption that you shouldn't believe it. Cash payments are interesting. So my advice on cash payments, so Bruce Marks at First Bank, like, you can't do deals with cash payments. I've certainly helped people do deals with cash payments. The thing that I recommend as a solution, and it's a little bit tough because you haven't earned the right to do it yet, but I helped this finance guy out of Philly who was buying a construction company. These things happen quite a bit in construction companies. He's like, they got cash payments, man. Can I get through this? I'm like, well, let's see. You're gonna need to tell the seller that, hey, look, I haven't earned this trust with you, but you've been taking cash payments for about 20% of your revenue. I'm gonna need you to change religions. So the only way that I can believe that, and the only way I'm gonna let my bank underwrite that, is if we kind of put it in a cash box for these 90 days that I'm doing diligence. I don't know you well enough, but I need you to change religions. I need to put all the cash that comes into the business into a box. I need to see it for these 90 days. So I need to be able to say in the first 30 days, this much cash came in, 31 to 60, this much cash came in, 61 to 90, this much cash came in. And I recognize that may have a fear that I'm gonna go tell the tax man on you, or you don't like the fact that cash is sitting around, and I know, but that's the only way that we're gonna be able to underwrite that cash, believe it. Alternatively, that portion is gonna go to seller note, and it may be 20% of revenue, but 60% of EBITDA on purchase price. Also, they're probably doing cash basis accounting or cash-ish. So like that a lot of those things had, month 1, month 7, month 12. And so you can sort of see that it's cash. And so that's another one. You actually open up a great question, Athena. Who wants to describe the difference in between cash accounting and accrual? This is going to be, all right. So accrual is supposed to match revenues and costs so that you can understand the revenue generated, costs incurred, profits made in any period. It tends to smooth financial statements out. So let me go back to, well, you saw like 1 month 80, 3 months of 0, 95, whatever. In 15 years of doing deals under $10 million of enterprise value, I've never seen a pure cash presentation or a pure accrual. Not once. They always answer, on my revenue recognition question in my QOE, oh man, accrual, leave me alone. Oh man, cash, leave me alone. It ain't never either one. It's always cash-ish or accrual-ish. As the difference in between the time when you deliver a service, pay your employees, and collect money from your customers, as that goes from same day or same week to something different, you get bigger differences in cash-ish or accrual-ish. But even like the neighborhood landscaping company, from like an individual house, they're gonna take money the day that they do it. But like when they're doing the apartment buildings, they're probably giving them 30 or 60-day terms. So now what you'll hear is, oh man, we do cash. Pay our people once a week. People, we collect the money right when this. Okay, well, 2 of your biggest customers are real estate developers or apartment buildings. Do you give them terms? Oh yeah, they pay us in 30 or 60 days. What's this accounts receivable on your balance sheet? We'll get into the balance sheet stuff in a minute. Oh, yeah, I guess we don't report in cash. Yeah, so then what we tend to do to keep everything in layman's terms, we just ask them to walk us through a customer engagement, both like the residential one and the commercial one, so that we can understand, okay, so what about the deposit that you force your residential customers to put up at the beginning of the season to make sure that they're still gonna stick with you? So that's not cash basis either. And so you start realizing when you ask the questions and have people walk you through a customer engagement, you start getting to the answers better. And then you're not gonna tell them that, oh, this is cash-ish or accrual-ish. You're just gonna, as a QE person or as a smart business-minded acquirer, you're gonna say, okay, well, now I can interpret it better. So like my revenue recognition question, frankly, in the past 2 years has become like the biggest question in the financials, because it's almost like the translation between like English and Spanish or Spanish and German. It allows me to understand the financials in the way that they're actually created versus me making assumptions. Now, software companies have a lot of deposits, so that gets you messed up. Other businesses that tend to, there's just a lot, and you'll see a lot of businesses in the SMB world that take payments at very different terms depending on the size of the customer. And even though a lot of their stuff may be cash, a lot may be accrual. What you'll normally see is that not many employees are gonna get paid on 30 days terms, so most employees get paid within the month. But then as you look at trailing 12-month numbers, you have to be careful that, did I move a payment on the front end of that 12 months outside of it? And did I move a payment on the other end outside of it? And so instead of 52 weeks of payment or 26 payments every other week, do we have 24 payments, right? And so you have to start asking those questions. The other thing that you guys should know as it pertains to income statements and people playing games, how familiar is anybody with year-end adjustments? I didn't learn this until 4 or 5 years in the Guardian. Anybody? No, shouldn't be, but in small business you should. Okay, so most of these small businesses don't pay a lick of money during the year and then pay some accounting firm that they call their CPA $1,500 to $2,500 to do their taxes. Well, our CPA does a bunch of year-end adjustments to create their taxes. One of those is most businesses aren't tracking depreciation through the year because it's really a tax construct. And so the CPA does their magic math at the end of the year and does that. They'll also move certain cash and accrual expenses and revenues in or out of the cash period for 2024. Well, and then also a lot of times, because nobody likes paying the tax man, they'll run a bunch of other expenses. That's when people buy their big trucks, their hunting lodges, and all that kind of stuff. It's typically December of name a year, right? Well, here's the issue. You're buying it as of May 2025 TTM, plus or minus, right? So any business in between January and May, they haven't done the year-end adjustments on those yet. And so if the company has a significant amount of year-end adjustments from the year earlier, you have to have some concept that that stuff is in the numbers you're looking at, but unreconciled. And so you can't be silly. The other thing that I'm getting a lot is I'm getting confidential information memorandums from brokers that you'll never know if they don't know or if they know gosh darn well. They used interim pre-adjusted 2024 numbers to make their SIM. When you pull the QuickBooks, net income is off by 150 grand. And you're trying to reconcile it, and I'm the new QOE guy, or you're the new buyer, so you haven't built the trust to call people out yet, so they think you're stupid. And then you ask the magic question, hey, was December closed, Mr. Broker, when you did the SIM? And they won't even know what you're asking. But if you ask it in front of a CPA or a controller, they'll say, oh no, I sent him interim stuff. I told him you should have changed that. And so that's something else to be cognizant of as you're looking at this stuff. Does that make sense, guys? And you won't have the trust enough to push your people, to push the sellers. You hire me, I'll push for you. Some of my competitors don't have it in them either, just keeping it real. And so you just gotta be careful about it. Good numbers come quickly. So if I ask for something and I don't get it in a week, I'm calling my client like, hey man, when I don't get stuff in a week, I think they're lying. I'm not saying they are lying, but if you're gonna bring $3 million in a Brinks truck in a couple of weeks, I think you should call that person to get that data. Athena, these guys are warming my heart. Man, this is a nerd's playground. and I believe it. But yeah, I got a pretty good one too. So why should you care cash versus accrual? And then before I forget, I'm gonna tell you how brokers and sellers are gaming novice buyers maliciously, that I've seen a few too many times. So you're right, working capital is one of them, but all right, I'm working on the land surveying company. So they'll go out and do land. So they'll take like raw forests, knock down trees, put in, electricity and water and stuff, and then sell it to a developer. But oftentimes, the developers have all the negotiating power. So you might do the work January, February 2025. They may buy it from you in March 2025, but they don't really get any payments, their first deposits, until October of 2025, and they may still string you for another 2 months on payment. And so now, not only is it a working capital issue, but I would call it a cash flow issue. I would call it, you're gonna need not just, you almost don't care about accrual financials at all because you have such a cash strap. And then notoriously, when you have big customers that have already strung you out for 9, 12 months, invariably they come back to you and say, hey, Elliot, I give you 85% of it today, man. And they know you're in a cash crunch, they know you have people to pay, and I just gotta keep it real with you guys. So if you have $100 of an invoice from March of 2025, and then in December of 2025, when these big guys decide to pay you, they say, hey, I got $85 of your 100 today. It's gonna take me another 2 or 3 months to get the full 100. The proper way to account for that is to $85 is cash, $15 is doubtful accounts on the balance sheet. And over time, you'll have an average amount of money on the balance sheet for doubtful accounts. So you can have a sense on average how much discount a company is taking. But a lot of these companies, either their financials aren't sophisticated enough or they're playing games, and they will adjust the invoices to $85 in December of 2025 to not have to tell you that it's 15% discounted. Construction, remodeling, all the rest of that stuff is really important. The one that came up 10, 15 times this year is work in progress, which is technically, Steve, working capital. So forgive me if I'm telling you something you know. But let's say I do 30 remodeling jobs in a year, and I'm on cash accounting. Not a big deal from an accounting perspective. But if I start a project in March, finish it in June, get paid in August, and I keep that on a cash basis, August is gonna look amazing, but I was paying out expenses all those months. Those months are gonna look deflated. I sold that work in December of last year. So really, I probably should have had it on revenue then because I took a deposit. And so now, both on a month-to-month basis, but even year over year, and inside of trailing 12 months and outside of trailing 12 months can be really wonky. But even more so on these project-based businesses, which like the stone business is a project-based business. There's not a manufacturing line of stones coming out, right? They're doing job shop kind of stuff. Well, if I do 30 jobs a year, and Steve, you buy it June 1st, I'm probably in process on 10 of those 30 jobs. Well, if I'm a seller, I'm gonna tell you all those jobs are, oh man, they're 80% done, man. They're almost off the line. They're heading out next week to the customer, bro. Like 80% of the expenses are done. Don't worry about it. You ain't gonna know, especially for some of my white collar clients who are going into blue collar businesses. Even if you walk the shop floor, you're not gonna know. Here's where you have to get into it like you do on revenue recognition policy. So we had to tell a bunch of venture capital and private equity clients who are knuckleheads, I'll throw myself into that bunch, hard to tell anything, that the work in progress is so poorly accounted for that on these 10 jobs in progress, I can't tell you definitively, even after all the data they gave me, is that 80% done, 10% done? Is done even the metric? Because I worked as a CFO of a telecom construction company. We were working for a Nokia sub. And until the customer went through their checklist on their time and said all the stuff that we did was done, it wasn't done. So we might be done July 1st. They don't want to pay out, so they don't show up and check the thing until December. So all this kind of stuff. And so that's another reason you care. A lot of times with customer deposits, you care in a big way as well. So you may buy something on June 1, they've got 10 projects, and they take deposits some of the time, not all of the time, based on owner's discretion. Well, on a cash basis, they should have reported that as revenue, did they? Is that truly a cash basis? Is it even on the financial statements that you're reviewing? Have they hit it and they're telling you you're gonna get 100% of the payment after you close, but they've already taken 40% and not put it on the balance sheet? All these kind of things make you care. And here's what I'll say. If a business is like approximating accrual presentation and they're in the size that we're looking at, it takes so much more rigidity. I know an owner overpaid relative to their peers to get a clean set of financials. So although I don't trust everything, I'm more likely to trust stuff because I know they overspent to get it clean versus someone who's cash. And now I almost have to ask like definitively on each important piece on the income statement and the balance sheet, what's in this, what's out, what if this happens, what if that happens? That's why like my jobs this past year, brother, I'll tell you what, and my clients think I'm crazy because it's 1 out of 40 lines and it's not QuickBooks or taxes. And their bank's already underwritten the thing. So they're like, why is this Elliott dude holding up? And it's like, because you don't know if this is Spanish or German, bro. That's why. And I'll tell you that on $1 million of EBITDA, you're paying 4 times they could have $600,000-$700,000 of deposits they didn't put on the balance sheet, which is going to kill your working capital line in 1 month. And even though you may have the profit in the 12 months after you purchase the business, you'll be insolvent in 31 days. I'll get right to that. I want to state one more thing before I move on. So I'll tell it in the story and then I'll explain how to watch out for it. So I filed my taxes in October. I bet you Athena does as well. Most business owners do. So we get an extension, we file them in October, boom. But we're getting this big brakes truck, right? And so the SBA sometimes will want the taxes just to prove it out and underwrite stuff. Well, I had a client who was buying one of these job-based construction-oriented businesses. I don't know if it was remodeling or like restoration, something like that. And it was the one where they would have a $100 invoice and would get paid $85 because their clients would stretch them. But they didn't input the invoice into their QuickBooks until they got the cash. So in a different way, you never knew if it was 85 and they got paid 85 or 200 and they got paid 85. So we had already alerted the client to that risk. We had alerted them that their financials were messy, even for folks that presented on a cash basis. These were messier than average. And then I kind of told my client, like, I wouldn't recommend this, but that's a stronger recommendation that I can give, right? It's not my money, it's not my life. So then the client went quiet for like a week or two. And I'm typically talking to my clients once a week, even post QOE, because they're going through fundraising. And oftentimes people will hit me up about fundraising stuff through the SBA or whatever, working capital if nothing else. I hadn't heard from them in 2 weeks. So, I'm sitting down one day and I'm like, oh, they're going to try to run a play on my client. They're going to try to file their 2024 taxes now that they know the QOEs come back tough. They're going to put fictitious profit on the 2024 taxes to make it look great. The bank's going to underwrite to the taxes. They may have even been using a pocket bank from the broker. And they're going to be telling my client that Elliot's just a crazy fool. Look at him on the internet. The bank's smarter than him. Pay my client this big check. Look at the taxes. There's $400,000 of operating income on this thing. And you see a thing that's covering her face. So I call my client. I'm like, hey, you just got 2024 taxes last week, didn't you? He's like, how'd you know? And they look really good, don't they? He's like, yep. I'm like, they're trying to run game on you. Let me just tell you how that goes. And he was like, dang, man, you're right. I was going off. They had talked me all in my ear. I thought I was going to be solid. The bank was underwriting it. A week later, I get an email that he killed the deal. That dude just quit his job and moved to the Bay Area. His wife had a technology job. It was a brother, Peter, but it matters for all you guys. He was going to be sitting on his wife's payroll, blowing through a bunch of money, causing a personal guarantee. He'd have been in a whole lot of trouble. But people will try to run game, and so you just got to be thoughtful. Like, why did the taxes come late, and why did they look so frothy? Why did they come miraculously after the QOE came in? Why are they trying to separate me from my advisors? Those are all things you have to kind of think about. So I feel like the murder cop. I've seen all the bull swing, and so I have a hard time trusting anything. Even though as a business owner, I'm optimistic, and I only deal with people who are high integrity. And I say this all the time, when somebody's getting 3 to 5 times every dollar they lie about, and a broker's getting 10% of purchase price, and they're 60, talking to my clients who are 20, 30, 40, 50, maybe 60 occasionally, you shouldn't expect to not show very easy to be manipulated. Also, a lot of my clients are running from 6-figure jobs into 7-figure opportunity, so they're very personally biased. And so, in my personal life, I try not to ask people questions where I know they're gonna have to lie to me. I don't try to walk people into a lie. When somebody's getting 3 or 4 or 5 times EBITDA, that is a situation where even the pastors and the deacons might start telling fibs. And then you'll never back out whether it was malicious and purposeful or accidental and nobody knew For me, if it's over 15 or 20%, I don't think anybody took home an extra 20% or was 20% light on what they spent last year and didn't know. So for me, malice is kind of out of the window, its magnitude, but a lot of stuff gets played, a lot of games get played. Let me hop into a balance sheet. So I think you asked a specific question about how do you know if it's a refundable deposit? The only way you know that is if you go into the contracts, which a lot of people are too lazy to do. Or, I say this a lot, man, like contracts are written in English language. So yeah, you can send them to your lawyer to read them, but you can actually read them, they're in English. And now you can chat GPT them. So, if you doubt how that works, and you should, look at the contracts. That'll also tell you, if they're telling you that the deposits are 10% and they're really 40 sometimes, that's a situation where a seller takes home a bunch of cash that you're gonna have to pay out. So as a new person taking over a new business, you should add new things to the chart of accounts to account for those things so that you can manage the business intelligently based on your monthly reporting without it having to be adjusted and sort of translated to Spanish or German. But again, so most of these business owners, their controller is somebody they know from high school that already knew how much they made 15 years ago. They don't want anybody else knowing how much they make. So typically these people are in way over their head. And then what we think, we'll just ask their CPA. Their CPA got paid $1,500 to do nothing but the cheapest tax H&R Block package. But they can't tell you like, hey man, they only pay me $1,500, so I'm making all this up to not make my client look silly. Leave me alone. But that's what a lot of these CPAs really probably should say. So what I'm saying is you shouldn't expect the refundable deposit to be broken out somewhere on the balance sheet. You're gonna have to ask the questions about revenue recognition to get to the fact that they take deposits, to then look at a couple of contracts to see how big the deposits are, to understand yourself and then make your own decision based on it. So here's the other thing. We don't do QOE and then say, hey seller, here's how you should have stated your financials. Look at how much you messed up. And I don't advise my clients to. It's just, hey, they said EBITDA was 1.2, we got 1.15. So we stated it differently, right? But it's still within zone, you're good. Or we're off by 30%, you should probably renegotiate, but you shouldn't expect a lot of that granularity. Couple of tricks. So people will say, hey, Elliot, the bank statements are in the data room. Well, let me start with the simple stuff. What is a balance sheet? And compare it to an income statement. Yeah. So when I think of, there we go, yep. So when I look at this $417,000 in April 22 for total checking and savings, that's the sum of all the money this company currently has in their checking account at the end of this period. The beginning of this period is actually represented at the end of this period. So the balance sheet is all of the accounts, both physical and kind of virtual, if you will, that are out here, right? I think of the income statement as a flow document, so all the revenue and expenses that flow through the company during a year, whereas the balance sheet is a snapshot. So at the end of April, this is the snapshot of the business. At the end of March, this is the snapshot of the business. Assets have to equal liabilities and equity, and frankly, in small businesses, the equity portion of the balance sheet you can almost ignore, as long as it balances, because you're gonna redo that as you buy it. But let's go through some of this stuff to kind of give you some tactical stuff to look at when you're looking at these financials. So a lot of times people say, hey, Elliot, bank statements, I put those Southeastern bank statements in the data room, man, what's up? I thought we closed that out. There's 10 other bank accounts that you guys have here. And so all the bank accounts a business have, typically that's one thing you can trust is that if they have a bank account, it's on here, because even their CPA who does their taxes would scream bloody murder if they had a bank account that wasn't on here. So now this business has way more bank accounts than an average one does. And even some of these ones that may not have motion in them in these 3 months, you still need to get bank statements for them, because any movements in bank statement imply cash in or out. You need to know why it went in or why it went out. So be careful about that one bank statement in the data room when you need 12. And I guarantee you the seller will he and ha about getting all 12. There's no other way to get through the process. One of my favorites, Steve, you asked about this, working capital. Is anybody holding $374,000 for the business somewhere in an account? I call these IOUs. So Peter, if we go out to the pub and I spot your bar tab on Friday, I have accounts receivable from you of $100. That's an IOU, Elliot. Next time we go out, man, I got you, brother. But it's not in an account anywhere. It's on your balance sheet. It's owed to me contractually. I should be able to collect it, but in reality, it's no stronger than an IOU. So you should know that, because you just went from hard-coded, go to the bank won't lie numbers, to this accounts receivable number that typically is the biggest number in your working capital. And now it's really not all that much stronger than a bunch of IOUs. And so that's why, as a QLE person, I'm looking a lot at historical accounts receivable, and has that customer paid you before? Have they paid in 30 days, 60 days, 90 days, not paid, whatever? Because I need to know how solid that number is. Again, on an accrual basis, a company should say, hey, for every $100 of AR, we collect 98, so there's 2% adjustment for doubtful accounts. So if you look at any like the Fortune 500 company, at their balance sheet, they'll likely have some allowance for doubtful accounts. You're not going to get that on the small business, so you need to do the work to kind of understand that. The next section is other current assets. So what is a current asset versus a non-current asset? Anybody know? I like that. That's exactly it. So these things typically can convert to cash in a year. The ones below it can't. But because somebody said that and put it in current assets, don't make it so. So like this due from Doc Rock, I'm not sure if it's due to or due from the way it's presented, but like let's say it's an asset, so it's likely that that money is due from that person. That don't mean they're gonna pay in a year. So that's probably not an account you want to take over as a new buyer. The Kristen Sanders stuff, Jamie Saunders, like that's not anything that you're gonna want to handle, right? You see this, these are in dollars. You see this employee advances. You're gonna wanna understand what is the nature of employee advances. So that may be a question that had you not looked at the balance sheet, looking at the income statement payroll line, you'd have never known to think about employee advances. But you need to understand that now. And then one of my favorites, inventory. So if you have a company with inventory, just know that there's a lot of games that can be played with inventory. I'll tell you two quick ones. So in the book Buyout by Rick Rickerson, he has a whole chapter about deal hell, where he tells a story when he was in private equity. He went to go look at a business that claimed they had called $1 million in inventory across three warehouses. So he's like, as a smart, young analyst, let me go visit the warehouses. I want to see the inventory, right? So he arranges, Monday visit, Tuesday visit, Wednesday visit, and the sellers at each one. And comes to find out later, they were moving inventory from one warehouse to the other because he announced when he was coming. And they had probably 1/3 of the inventory that they actually stated that they had. So one of the big questions when companies have inventory is how well do you track your inventory? It's very similar to that revenue recognition question and work in progress question. And I'm trying to tell you these things because if whoever is doing your diligence doesn't ask these questions, just know they're leaving you real naked. So some companies don't have a good control over their inventory. They don't have an inventory control system. They'll tell you that they only buy inventory when they need it. Whoop-de-whoop. They'll say, oh, that number's not accurate. We don't have $1.1 million in inventory. It's closer to 900,000 or 2 million. Or some of that stuff was bought in 1995 and it's not sellable. And so with inventory, you have to ask, how do you track inventory? Who tracks it? Is the number on the balance sheet accurate? Is any of that stuff old? Inventory should be held and everything should be held at the initial cost on the balance sheet. So this should be the aggregate of all of the initial cost of all the inventory purchased, whatever date they purchased it. Not everybody adheres to that, so there can be a lot of wonkiness there. And then a lot of people, if they don't have an inventory control system, the reason that shows up is because where does sold inventory show up on the income statement? So if I don't know if I put one widget into a product or 3 or 5 because I don't have a good control over it, then all of a sudden my product portion of cost of goods sold is an estimation, and I know it because if you can't track inventory, there's no way you can tell me that the inventory that you moved over into the product portion of cost of goods sold is accurate. So now we're dealing with how good is your estimate. And that's another reason why understanding the inventory on the balance sheet is so important, and why some of these questions that might come off as pain in the butt questions to a seller who's thinking you're just some spreadsheet cowboy matter to your pocketbook. They matter in working capital, but also how believable is the income statement. And then fixed assets, this is all the trucks, equipment, stuff that they have. And so a lot of times small business owners say, oh, we don't have an equipment list. There's your equipment list. So, how much is owed on this Toyota forklift? How much is owed on this Mercedes S5500, right? You see accumulated depreciation in line 72. So that's the tax depreciation they've taken historically against all these assets. So like if I look at, I'm looking at the annuals here. So if I look at, they have $1 million of accumulated depreciation and a whole bunch of fixed assets. So most of these fixed assets have been fully depreciated. You might want to assume that that means they're old, but the tax code has allowed it for accelerated depreciation in several of the last 5 years. So some people were able to depreciate 100% of assets in a single year. So a lot of times on the balance sheet, what you need to do is see this as a list, but you need to understand what's on the balance sheet, but you also need a current market value. So for instance, like if they're using a 3-year-old truck in the business, that truck may have $50,000 of value, but 100% of that value may have been depreciated. And those are different figures that are important to you as a buyer. So make sure you get some estimate from the seller of what the fair market value of this stuff is. If you can't assume it or guess it, like a manufacturing facility or a tow truck company, go get the stuff appraised. So let's imagine a manufacturing company that delivers stuff and has one machine they bought last year, one machine they bought 20 years ago, one truck they bought last year, one they bought 10 years ago, and they did accelerated depreciation on all of it. So you might say on a net basis, they only have $100,000 worth of net assets. But really, that truck that delivers the stuff might be worth 50 grand. That machine that they bought last year might be worth $1 million. That 20-year-old machine that works may have value, but it could break on you any day, and you'd have to replace it at something close to $1 million, which wouldn't be in Steve's working capital calculation. And so that's why you need to understand not just depreciated value on the balance sheet, but market value, age of assets, replacement value, all those kind of things. Because again, I mean, imagine a lot of these manufacturing businesses have 10, 20-year-old manufacturing assets that still work. Oh man, that thing, it's been gone for 20 years, it'll go forever. But if it breaks on you and it's got a $500,000 replacement cost and your whole working capital line is 300 grand, you're screwed. So I came up in trucking private equity. Steel manufacturing private equity. I'm a former mechanical engineer. So the other thing that's related here is she said maintenance CapEx, but there's replacement CapEx too. So what's CapEx? Somebody give me a shot at that. So in trucking, well, another way to say that is crap you got to spend money on that doesn't show up in EBITDA or working capital, but can screw you, would be another way to describe CapEx. And something that, excuse me, like a sucker buyer wouldn't see until they might have spent 100 grand on QOE and legal, not representing that EBITDA wasn't a great valuation metric for this business. So in trucking businesses, you can have $3 million of EBITDA and under $1 million of cash flow after only adjusting for CapEx. So in businesses that have a lot of CapEx or a lot of assets, the first thing you need to look at is that SDE number on the SIM is like toilet paper, because you have to subtract CapEx. And if a fool's gonna pay a multiple on SDE, you gotta wait till they get in there and the bank won't underwrite it so that the people come back to the planet from up in the clouds. But it's the maintenance stuff is what Athena was saying. So you have a maintenance contract, so you might pay, 50 grand a year to have somebody maintain, right? But then you have replacement CapEx, which every 5 years, you got $250,000 amount of money you got to put up. So whether you count for that in your working capital or you spread the 250 out over 5 years, or however you do it, if you don't account for it correctly, you'll be in trouble. So I had some clients who were buying a trucking business. It was like distribution. So it was like more than trucking, it was logistics a bit, but it was trucking at the end of the day. And, we're tasked with looking at EBITDA, right? So I assumed that they had understood CapEx and understood the bet they were making. And they were like financial dudes, right? It didn't come to me until I get a call and they're like, hold on, man. I'm looking at this EBITDA versus the cash flow and I account for having to replace the trucks. And I don't think I have any cash here. And he's like, well, how do I do the cash flow analysis on this? And, that's not in the QOE, but I've done trucking so much that I just kind of did a spitball on the side. But you have to know what's the annual maintenance on 10 trucks. What is their replacement timeline? So some owners choose to replace like 18-wheelers every 3 years before they get off of their manufacturer's warranty. Some every 5 years before their market value drops off a cliff. Some 15 years until the wheels fall off. And you need to understand how they've done that historically. And then into your cash flow assumption, you need to put, okay, well, 3 trucks are gonna be needed to replace next year, 5 in 3 years, 2 in the other year. But also as a smart buyer, and there's a couple of good podcasts on Inquiring Minds, let's say you got 3 trucks doing your whole business and 1 truck breaks down, that could be a third of your revenue that might be down for 2 or 3 weeks. And if you don't have like dedicated maintenance resources or like a dedicated agreement for a rental to cover it, even if you have the cash that's gonna be a pain in the butt to pay to fix the thing, it may impair your revenue 30% for a month. That might eat up all of your cash flow for that month and make your debt payment really hard to pay. And so another wrinkle that's balance sheet oriented in valuation is for businesses with assets of any significance. You have to consider both maintenance and replacement CapEx, and they're gonna call you crazy. The broker's gonna call you crazy, the seller's gonna call you crazy. The bank will sort of understand, the credit committee will understand, but the salesperson at the bank may not. And so you have to be strong enough to know, I can be called crazy, but if I don't account for this cash, I'll be insolvent. And these numbers that I kind of brushed over are net numbers. So that means that let's say I bought and sold 10 trucks in March of 2024 or in the trailing 12 months ending March 2024. I'm gonna adjust the accumulated depreciation for all the assets, and the total fixed asset is gonna be the net number. So it might go up 400 grand, but I might have spent $1 million, but sold some assets. And so again, to Athena's point, in heavy asset companies, you really have to dig into this part. And if you don't understand it, get somebody who does, because the balance sheet tells you directionally, the depreciation tells you a little bit less directionally. The cash flow statement, which you rarely ever get, will give you a bit more, but oftentimes they're not done correctly. So if it's heavy asset, don't be silly. Love to come back. I would just say the same analysis that I was telling you about current assets and fixed assets. Make sure you look at current liabilities and long-term liabilities. Accounts payable is what you're paying on payroll, but a lot of times people will stick stuff in here. The other thing on balance sheets that you got to be careful about is certain expenses you can capitalize. So like if I buy a truck, I can capitalize that expense on my balance sheet. It won't show up on my income statement. But some sellers will capitalize expenses that really should be run through the P&L. And you'll see it because you'll see these wonky lines on the balance sheet, and you'll ask what's in it, and there'll be expenses. So a lot of times the maintenance portion of CapEx is actually an expense that runs through the income statement. And so you need to understand that running through the income statement purely on the balance sheet. So you won't be great at balance sheets right away. Challenge yourself to be a little bit better each day. And that's what I would end with. Yeah, you're not gonna know most of this stuff pre-LOI. Play to win pre-LOI broadly. And I know Athena has your guys back to not do silly things, but play to win. Once you get the data room, there's stuff you can do yourself before you pay somebody like me. And frankly, week one after a letter of intent and a week before to me are the same date. So I don't think you really extend yourself that much. The other thing I'll remind you is like that HVAC or roofing or whatever company owner has been selling for 30 years. They put kids through college, paid mortgages, right? There's 15 or 30 employees that paid their mortgages and put their kids through college on his ability or her ability to sell. They can certainly sell you some bullshit.
I love listening to you, Elliot. I learned so much from you, and I just love the no nonsense. Thank you so much. This was super valuable. I'm sure everybody here got as much value as I just did, and really appreciate you taking the time and just giving us your expertise. Um, Hopefully, we'll
Yeah.
get you back again because you're one of my favorite guests because there's so much to this. It's so important, but I love how you explain things and the energy you bring to it. So thank you so much.
Awesome, guys. I love it. I'm a nerd in that way. If you need something, holler at me. Thanks for having me.